Let's take a look at this project evaluation internal rate of return problem. I'll read it to you. Your firm is contemplating the purchase of a new $780,000 computer-based order entry system. The system will be depreciated straight line to zero over its 5-year life. It will be worth $45,000 at the end of that time. You will save $310,000 before taxes per year in order processing costs, and you will be able to reduce working capital by $55,000 at the beginning of the project. Working capital will revert back to normal at the end of the project. If the tax rate is 35%, what is the IRR for the project? Okay, well, let's look at some key pieces of information that we need to solve this problem. First, we see that the system cost is $780,000. Annual depreciation is computed by taking that cost and dividing it by 5, so that gets us $156,000. Now we're going to get a tax shield, savings that is, from the depreciation. So we take the annual depreciation times the tax rate, and that's the dollar amount of the savings we can expect to get as a result of recording depreciation, which doesn't involve any cash flow, but Uncle Sam lets us to record that deduction. So we wind up saving taxes if we're in a 35% tax rate. And that's how we derive the $54,600. Then they gave us salvage value at $45,000. But if the equipment is fully depreciated, we will record a book gain on that equipment, and that gain is taxable. So we need to compute the after-tax cost of that salvage value. And when we do that, we take the $45,000 times the 35%, or 1 minus the 35% tax rate, and the salvage value after tax, in other words, the cash flow that we're going to yield when we sell the equipment, will be worth $29,250. That's how much cash we will receive after considering the tax ramifications of selling the equipment at the end of the project. And then they also told us that the order processing savings were $310,000, but those savings will equate to higher income. So we need to reduce the savings by 1 minus the tax rate to come up with what the net cash flow savings from the net cash inflows would be as a result of the order processing savings. And when we multiply 310,000 times 1 minus 35%, we come up with $201,500. Okay, we've got the key pieces of information appearing in column B through rows 1 through 9. And let me illustrate how I would lay this one out. I would drop in the periods going across, and I would put together a schedule of cash inflows and outflows. Okay, and I think I've got all of these lumped together, and I've worked this ahead of time just to save some time in the demonstration. So let me bring some of these to light. So we have the system cost that occurs right now at year 0, which stands for today, and that's a cash outflow which I will show in parentheses. Okay, and then we have to compute the tax savings from depreciation, which was given above as $54,600, and that occurs in every year 1 through 5, right? Then there's the order processing savings after tax, and the order processing savings occurs every year 1 through 5, and that was given as $201,500, right? We took the 310 times 1 minus 35%, so you can see it solved there. Okay, next we have the working capital savings, and they tell us in the working capital savings that we're going to save $55,000 up front, but then working capital reverts back, so we need to show that there's a cash outflow at the end of year 5. We also have a salvage value after tax, and the salvage value after tax will only occur at the end of year 5. Now I've put in a bunch of zeros here just so we can see that there's an underline so that we can compute the net cash inflows in all periods. Alright, and when I lay all of those out, you see there's our schedule of projected cash inflows and outflows, and this considers the tax ramifications. And remember, the $29,000 salvage value, which came from cell B6, was the result of having to record a gain since we fully depreciated the equipment and pay taxes on the gain. So that's why the salvage value would be reduced. Okay, and then what we do is we plug in the internal rate of return. And why don't I just step through that? I'll bring it to light and then I'll step you through what you do. Okay, you can hit the formula bar right here and it'll bring up the function arguments, and the values occur in cells B19 to G19. So there's B19 through G19. That's our schedule of cash flows we're projecting occurring in annual buckets. And then it also asks us to put in a guess. Now you really don't have to. It probably will guess the right one. I tend to use a realistic number, so we'll enter 10%. Right? And the answer comes back to internal rate of return of 21.92. Let me slide down so you can see that a little bit better on your screen. Just a little bit more. And that's the answer to this problem and how I would go about solving it.